Hello everyone. So we now turn to the second part of the course on financial derivatives and risk management in the energy industry. Right, so we're going to start with futures, and then we're going to talk also about swaps and then options. All right, I'm going to assume that you have either done a course on derivatives and you're familiar with the basic concepts of futures, or if not, please read through these chapters in whole. There's also another video and handouts on the course webpage guiding you through this material here. All right, so some important concepts when we're trading energy futures. So the first is about the relationship between the futures price and the spot price as we move through time, right? So the first idea is that there is this parallelism between these two prices, the futures and the spot price. However, this correlation has different intensities depending on the market. It is stronger when it is easy to store the commodity for delivery in the future. Okay, in that case, if storage is cheap and easy, then whatever affects the spot price will also be reflected in the futures price. Okay, if that correlation is very strong, then hedging works well. However, in other markets, as we'll see later on, that correlation is weaker, and therefore hedging becomes less effective. Right? Second concept is that as we move through time and get closer to the delivery date of the futures, then it has to happen that the two prices converge. So the spot and the future price have to be the same at the final date. Otherwise, there is arbitrage opportunities, right? Again, this part here is also discussed in those initial chapters of Hull. If you have not seen this before, please go back to those chapters. All right, now another concept. Before we were talking about what happened as we move time forward, I mean from today, tomorrow, and so on. We're moving on through time. Now we are fixing time right now, today. And what we're going to do now is to look at the different prices that I can observe on the market today. So this is the spot price today. This is the futures price today, but for delivery in 1 month. This is the futures price today, but for delivery in 2 months, and so on. So I have basically the futures curve. So this curve can have two possible shapes. One is upward sloping, like we have here, and we call this a contango or a carrying charge market. This is kind of the normal equilibrium situation because there is this trade-off between two alternatives that a firm can do. So if someone needs to have this commodity for production in 1 month, there is one alternative, which is to buy it on the cash market, on the spot market right now and store it. Or instead of that, you can just today enter into the forward contract or futures contract to buy it later on. So in that case, you do not you do not need to spend storage costs. So you save storage costs, which has to mean in equilibrium that this price should be higher. Okay, so you get this upward sloping curve. Okay. However, in other markets, we see the opposite. We see that the futures curve is downward sloping, like you see here. Okay, and we call this a backwardation or inverted market, okay, in the sense that it is not a equilibrium normal situation. What this suggests is that when you see this, it suggests that there is a convenience yield to holding there's a convenience yield to holding the actual commodity rather than buying the futures. Okay, again, and this may be due to the chance of shortages. So, for example, this is common in the oil market, suggesting that there is a high convenience yield in the oil market. Again, this idea of convenience yield is explained in Hull in those initial chapters. If you're not familiar with this, please look at those chapters. Another important concept here, it's the basis. So usually we just have this simple expression here for the basis, the difference between the futures price and the spot price. However, here in commodities, in energy commodities, things are different because there are many spot prices depending on the location where you are trading the underlying. So we usually decompose this basis into two parts by adding and subtracting S star, where S star denotes the spot price at the delivery location of the futures. And this S, which is the one that was here, it's the spot price that I care about, the spot price at my location. Okay, so this is probably easier to see with a figure. Let me open a figure here. Okay, so what we are doing here again is decompose the usual basis into these two components. The first component is the difference between the futures price and the spot price at the delivery location of the future. So it's the usual basis, if you will, in other easier derivatives. And it displays this behavior here. As we near the maturity of the futures contract, this basis goes to zero. Okay, and we call this the storage basis, right? What is new now is that if I need the commodity not at that specific location where the future is delivered, but at some other location where my plant is located, what I also care about is this other part here of the basis, which is the difference between the spot price at the delivery location of the futures and the spot price at the location where I am, at my plant. And that difference here does not need to go to zero. It may remain constant throughout the life of the futures. Okay, so we're going to call this location basis. So futures will allow us to hedge this part here, but we will need to use some other instrument, as we'll see later, to hedge this remaining part here. Right, going back to the PDF here. Okay, so what we're going to do now is to look at the major derivatives in the energy area, in this area here. We're going to look at these two major exchanges. I particularly like the web page for the CME group. If you come here to the CME web page, it's very nicely organized. You can come to markets, energy, and you will have here a lot of information about the top 10 energy products, and then in more detail about derivatives in each of these areas. We're going to look at some of these contracts, like crude oil futures, the natural gas futures, diesel futures, gasoline futures, coal, electricity, and so on. Okay? Again, this page it's very well done. If you click on these links, you'll see a lot of information on the contract itself. From here you can get prices and so on. Again, I highly recommend that you read through this website. Okay. So going back to the handouts. Let's start with the crude oil futures. So the one we were just looking at is this one, the WTI futures. It's trading on the CME. This is the size of the contract and so on. The delivery date is at a specific location in the U.S. market, which is the center of the oil market, Cushing, Oklahoma. The other major reference in the oil market, if you recall, as we discussed, is the Brent crude oil. The main contract for that is a contract on the Intercontinental Exchange, right? And this is the characteristics that contract has. You will also notice that there's a lot of cross trading. So you will see the CME trading contracts, future contracts on the contracts of the other exchange, on the Brent futures as well. All right. So this is the typical shape of the oil futures curve. The red line is it's the WTI futures on this specific date, and at that time this was the other futures, the Brent futures. There was a big price difference. It's not always like this. There were some specific conditions in the market that generated this big price difference here. Again, if you want to read back and go back to that's these type of things that you have to understand about the physical properties of the markets, what was explaining this difference here. At the moment, there were some factors having to do with pipeline capacities and so on that made this price of the WTI very much lower than the Brent price. Okay, so let's, what we'll do here in this chapter is to go through some simple examples of how to hedge using these derivatives, okay? And this is the simplest possible example of a hedging strategy. So suppose we have a crude oil producer, so a firm that takes oil out of the ground and sells it. And the risk is obviously that prices go down because that's their output price. So to hedge this, you need to take a short position in the futures. Who may be on the other side? Someone for whom oil is an input, like a refinery. Okay. So you have here a very simple example. Please go through this. I mean, there's some numbers here, and if you have any questions about this, then let me know in class. Okay. All right. The next example is about refined products. So coming back to the CME page, energy. What we are going to look at now is what is the output of refineries. So these main two futures here. This stands for ultra low sulfur diesel futures, and this is gasoline futures. Okay, we're going to look at these two here. So these are the characteristics of the two contracts. Again, I just copied this from the description on CME's website. The size here is in gallons, 42,000 gallons, but recall that 42 gallons correspond to 1 barrel, so this is actually the same size as the oil contract, is 1,000 barrels equivalent. Okay, the prices are quoted per gallon instead of per barrel as before. Also physical delivery at the New York harbor. Okay. So here you see the typical curve for these futures. Right? This is the heating oil. Okay. You can see a little bit of seasonality here. The curve increases a little bit in the winter months. Okay. Think about why this is. We can discuss this in class if you have questions. And then you will see this curve for gasoline, and here it's a more strong seasonal pattern. And here you will notice that it goes up in the summer, right? Here in the summer. Again, the reason for this is specific to the market. This is the US market, the East Coast, and why you see these seasonal patterns here has to do with how people use these fuels in that location, in that part of the world. So we can think about why it justifies this, and let's discuss it in class. Okay. So here's an example of cash futures arbitrage, right? Recall that if futures prices exceed spot prices by more than carrying charges, there is an arbitrage opportunity, which is a cash and carry arbitrage. This recall here actually means this is explained in those whole chapters at the beginning of the section. There is a relation saying that future prices have an upper bound that has to do with carrying charges, right? So here the example is the following. We're going to have a situation where that upper bound is not verified, and therefore there is an arbitrage opportunity. Okay, in the case here is the following. This spot price is 2.9. Then these are the costs of storing and financing, the carrying costs. And we have a futures price for 1 month at 2.95, right? I mean, and just eyeballing, you can see that this number is too high, right? Because if you add this with this, it's less than the futures price. So the futures price is above the upper bound that you can see in chapter 5 of Hull, right? So the arbitrage strategy is to do what? Today you buy the spot at 2.9 here. You store the oil for 1 month at this cost here, but you don't pay it right now. Just this is paid at the end of the month, and at this moment right now you also enter into the futures contract by selling the futures. So you short the futures, right? When you get to the end, 1 month from now, what you do is you pay those carrying costs, right? You sell the oil that you have stored through the futures, right? So guaranteeing this 2.95 price. So you can either do this in two ways. You either actually deliver on the futures, all right, and you get exactly that price, or you close the futures and you sell the oil in the cash market. But if you do this, as the spot price cancels with this, which gives you a net of 295, which is exactly the same result. So the two alternatives are equivalent. So in either case, you get 295 for the oil that you're selling. All right? So you sell for 295, you pay 0.02 of carrying charges, which gives you a net of 293, which means that 293 minus the price you paid here in the beginning, 2.90, gives you a profit of 0.03. Another example is this futures arbitrage. It's a very similar argument. The previous case showed that the future price could not be above the spot price by more than carrying charges. And here the reasoning is very similar in the sense that a futures price for 2 months cannot be above the futures price for 1 month by more than carrying charges. Right, so suppose this example here, you have the 1 month price at 292, then you have again this cost of 0.02 to store and finance 1 unit, and the price for 3 months it's at 297. Right, so again you can see that 292 plus 0.02 it's 294. So clearly this value of 297 is too high. Right, so what is the arbitrage strategy? It's very similar to the previous case, but instead of trading on the spot and futures, you're going to trade on 2 futures, right? So what you do today, you buy the one that is cheap and you sell the one that is expensive. So you buy 1 month, sell 3 months. When you get to 1 month, so 1 month from now, you take delivery of this first one here. You take delivery of this contract where you were buying, okay, at the price of 292, which was agreed in the beginning, and then you store it until the end of the next contract. So at this moment there are still 2 more months to go for the 3 month expiration, and so you store the oil for 2 months. At the end of the 3 months, what happens? You pay the carrying charges of these 2 months, so 2 times 0.02, that's 0.04 per gallon. Okay, we are ignoring time value of money here, but we just have to compound the intermediate payment. But for now, we just ignore it. You sell the oil at the price that you agreed in the beginning, 297. You were selling here the future, so you sell the oil for 297, and that gives you what, a profit of 0.01 per gallon. That comes from where? Comes from selling at 297, and 297 plus 0.04, that's 293, and you purchase this at 292, right? So 297 minus 0.04 minus 292 will give you a profit of 0.01, right? All right, the next market is natural gas. So that is these futures here. It's the second most important future on the exchange, and so this natural gas, it's an important big market, and this is the one we're going to look at. All right, that's the description of the Henry Hub natural gas. Recall that Henry Hub was the main pricing location in the U.S. market. The contract size is 10 million BTUs. Price is in dollars per BTU, and we have a long curve from 1 month to 12 months, 12 years out. Okay, the delivery is physical at the Henry Hub location, as the name suggests. There are other contracts in other markets. For example, one important contract in Europe is the UK natural gas futures. It's trading on the ICE exchange, and you have here the characteristics of this contract. It's slightly more complicated. The size of the contract actually depends on the number of days of the delivery month, through this expression here. We defined what a therm was in the beginning when we talked about natural gas, but you have here the ratio from therms to million BTUs. This is the curves for the two contracts. This is the Henry Hub curve. This is the UK curve. And again, it's interesting to note the seasonal patterns here, right? So it's an upward sloping curve, but then you will see that there is always this small hump here, okay, in the winter months, okay. again, to understand the seasonality, you have to think what is going on in Henry Hub to make this type of pattern through the year. Okay, so think about this, and we can discuss it in class. All right, an example of how to use this for electricity generator, right? So recall that this type of plant will buy natural gas to generate electricity. So for this plant, the natural gas is an input, and we're going to look at some example where it makes sense to hedge, right? So this is the description of the case. Suppose this is the size of the plant with an efficiency of 50%. The context here is that the risk manager is expecting the next winter to be cold, which would drive up natural gas prices. Okay, and this kind of answers the reason for this seasonality here. And now a typical situation is the firm may not be located on that exact location on the Henry Hub. It may be located somewhere else, suppose on the East Coast. So there is that difference between the two prices as we have discussed before. But for now, we're going to ignore this. For now, we're just going to hedge the price at the Henry Hub location, right? So we can have a bunch of trades for different months. In this example, we focus on one of the trades, the one for January. Okay? So we have the market prices for the futures. We have to estimate how much gas we will have to use, and for that we have to estimate how much electricity we're going to generate. This is the information here. We're going to be generating 100 megawatts for 10 hours, so 1,000 megawatt hours per day during 31 days of January, right? So what is the hedging strategy? We have to find out first how much gas we will have to use, okay? And you have the answer here. Please go through these calculations. This is exactly the same type of calculations we did before when we talked about the natural gas market, right? So find that we actually need this amount of gas to generate the amount of electricity that we are assuming here. And then once you have this quantity, you just have to divide by the size of the contract to determine how many contracts you need to trade, right? And then you have here an example, a scenario, for example, in that month, and when we get there to January, let's say that this is the actual market price, and what this example shows you is what is the result of the hedge, right? So please go through these numbers. I think everything is detailed, but let me know in the end if you have any questions. Okay, the next market is coal, and actually here we're not going to talk about this for the following reason. So this is one typical example of a futures contract for coal. This is the characteristics. But then when you look at the curve, at the forward curve for this contract, it looks like this, right? Very neatly like this. All the values are very lined up in this very regular stair pattern. Okay. So what this suggests is that trading is very little in this contract or not at all, and these are just prices that some dealer is posting without probably having any trades behind these prices, right? And as you can see on the CME page, trading in coal is very thin for the reasons we discussed before when we talked about coal markets. There's not that much trading going on, right? So we are actually going to skip this part here of futures on coal because again it's a very thin market. Next we turn to electricity futures. There are many different electricity futures which depend on the location, on the hours of the day, whether peak or off peak, and whether and on the type of market, the day ahead market or the real-time market. We're going to look at one specific contract, which is this futures with this big name, PJM Western Hub Peak Calendar Month Real-Time LMP Locational Marginal Pricing Futures. So if you look at the exchange, what we are looking at is one of these contracts here. This one here, the PJM Western Hub peak real-time LMP. Okay. So these are the specifications of the contract. Again, it is for this specific market, the Pennsylvania, Jersey, Maryland. It is for a specific point in that contract, the Western Hub. It applies for peak hours, so daytime hours between 7 and 11 at night. And it's for calendar month, meaning that it applies for a month, and for that specific month we have to look at the calendar to find out exactly how many peak days there are in that specific month. It's the real-time market, and it has this here, the LMP designation as well, because if you recall when we talked about electricity markets, in this market there is locational marginal pricing, so there are different prices on the network. The contract unit is 80 megawatt hours, meaning that it is 5 megawatts per hour, and there are 16 hours there are 16 peak hours in the day, so 16 times 5 gives you 80 megawatt hours. Then there is this specification here that you need to trade a multiple of the number of peak days in the specific delivery month. Okay, so let's look at an example to see how this works. Oh, before that, this is the typical curve. Again, there are strong seasonal patterns here. You may see that there is a big spike here around these areas, which are the summer, okay? And then there is this smaller hump in the winter, okay? So think about what are the characteristics of this specific location, of this specific market, that may justify this pattern in the consumption of electricity, okay, and therefore in prices. All right, so the example is for a utility company. So now we're taking the point of view of a firm that buys electricity in the wholesale market and then sells electricity to retail customers, okay? So it's the input for this company is the electricity. Right, so the scenario here, suppose that the risk manager is concerned that the hot summer will drive up peak power prices in August. So what we want to do now is to hedge the input price of this company. Right? So how much? Let's say we estimate that we need 20 megawatts for each peak hour, and then we observe in the calendar that this specific August has 22 business days. And this is the price that we can get on the market right now for delivery in August. Okay, so the hedging strategy is to go long. I mean, long because we are hedging an input price, so we want to guarantee the price at which we will be buying the input. And we have to determine this number here, 88 contracts. So to see in more detail how we get to this number, let's look at these calculations here. So as described before, the contract unit is 80 megawatt hours per contract. Given the expectations of demand, we want to hedge this amount of input, which is 20 megawatts during each one of the 16 hours that there is in a day. So we want to hedge 320 megawatt hours per day, okay, this amount. So given that this is the quantity that we want to hedge and this is the contract quantity, the multiple that we get is this ratio here. So we have to trade 4 contracts per each day of the month that we want to hedge. So the total number of futures that we're going to trade is that multiple times the number of business days in that August that we are hedging. So 4 times 22, we get 88. So that's the number of contracts that we need to trade for August. All right. So coming back here, so that's the strategy. And then this is a scenario. So suppose that when we get there, prices are indeed high at $60 per megawatt hour, and this is the payoff that we get from being long in the future. So we bought in the beginning at 54, now it's at 60. This is the payoff to the long futures, and this is the amount that we get, and that will compensate us for having to pay the higher price of 60 in the spot market. And the net result is that we are paying just $54 that we wanted. All right, that's it.